tacos, y tacos y burritos. Domino's. What's going on, Investomaniacs? It's time for your Robinhood daily stock market update. Up first, we've got Domino's. And that's the self-driving minivan coming to Texas. More cheese, less human. Domino's is launching self-driving pizza delivery in Houston, Texas. Later this year, the fully autonomous minivans are named R2. Oh, sense my pizza delivery coming, I do. And that's created by California-based Neuro. The startup was founded by two Waymo engineers. That's Google's self-driving car side hustle, who tested them out in the dry heat of Scottsdale, Arizona, thinking if anyone gets hurt, I mean, come on, you don't have much to live for if you live in Scottsdale. Here's how it goes down. These adorable pizza-packed vehicles are purpose-built, designed to deliver your carbs as efficiently as possible. No room for people. At 8.5 feet long, the R2 has no driver's seat, steering wheel, or brake pedal, just pizza box storage. No sidewalks. Unlike Postmates and Amazon's mini bot delivery concepts, R2 rides with traffic at 25 miles per hour. Although you wouldn't want to be stuck behind that going 25 miles an hour, would you? Easy, happy process. Houstonians, is that what we call them now? Houstonians can open their Domino's app, click robot delivery, and they'll receive a PIN when R2 arrives. Type those digits into the delivery bot and boom, it's pepperoni time, it's t-shirt time. The takeaway, Domino's is cutting humans from its diet. Just as Uber and Lyft are banking on self-driving cars to help them achieve future profitability, because who knows if it's going to happen without that, the pizza chain wants to avoid delivery boys to save costs. It's thinking like a tech company. We counted 3 other Domino's partnerships that are also looking to cut out drivers and their costly wages. One in New Zealand with an aerial drone startup for delivery, one in Michigan with Ford for self-driving cars, and one in Europe with smaller sidewalk-loving delivery robots. Pfizer pays big strategically for a cancer-saving drug company. Pfizer really wanted these drugs. New York-based pharma giant Pfizer just dropped $10.6 billion for cancer drug company Array BioPharma. Pfizer wanted Array so badly it offered $48 cash per share to buy out the whole company. That's 62% higher than Array's stock was trading on Friday. 2 cancer-crushing future moneymakers. That's what Pfizer gets. Britovi and Mektovi are both approved to treat skin cancer, including melanoma. You know what else treats that? Sunblock. Pending the results of a couple other studies, they could treat colon and rectal cancer patients too. Guess how much each of those drugs cost per month? $11,000. That adds up over the life of a cancer survivor. The takeaway, life-saving monopoly drugs are good for business. Life-improving non-monopoly drugs, not so much. Pfizer got famous with erection-helping Viagra and cholesterol-hating Lipitor. Both face competition now that their patents expired. Online disruptors like Hims and Roman copied the generic versions. That's why Pfizer's buying up these life-saving cancer drugs. Blue Apron pulls a reverse split in a desperate move. Not a good sign. Blue Apron just completed a reverse stock split. It's combining 15 really tiny Blue Apron shares into one kind of reasonably sized share. That financial engineering boosted the stock price from 55 cents to over $8 in one day. The struggling meal kit pioneer pulled off the maneuver for 2 key reasons. Psychological, seeing the stock price fall from $10 to $10 at its IPO down to less than $1 in under 2 years, well, that's kind of depressing. And when potential investors who aren't that smart, see it go back up to $8, they're like, oh, look, that's doing like went from 55 cents to, I don't know how that works on people, but apparently it works. But of course, the real reason the minor leagues. The New York Stock Exchange may actually delist stocks that are less than $1. If they stay below that price for too long, the stock is regulated down to the over-the-counter markets, also called the OTC markets, and you do not want to be there. Companies will do anything. Hey, just look at, what was that company, the Helios and Matheson? That was a little silly, wasn't it? The takeaway, Blue Apron warned us this could happen. When Blue Apron prepped to become the first publicly traded company focused on zucchini-wrapped salmon entrees for your night in, it was honest with investors about the risks it faced. Here are the top 3 concerns the company listed in its pre-IPO S1 document, all of which have come true. Number 1, we have a history of losses. That's not exactly the first sentence you want to hear. We have a history of losses, and we may be unable to achieve or sustain profitability. Hey, that first profit champagne reward, well, it's still sitting in the fridge and it's flat. 2, if we fail to cost-effectively acquire new customers or retain our existing customers, our business could be adversely affected. Yeah, well, they didn't really do good at either of those. Number 3, if we fail to manage future growth effectively, our business could be adversely affected. That happened. If you want a little bit more information on Blue Apron, I do have 2 previous videos on why you should not invest in that company. At least that's my opinion. And your snack fact of the day, an estimated 90% of the money donated to fix up the fire-damaged Notre Dame Cathedral in Paris came from American donors. Not exactly sure what that means or how I should feel about it. Anyway, that's your stock market update for the day. Hope you guys have a good one.